Apple hit a new all-time high at $315 per share late last week. Here's what the AI stock analysis caught in the footnotes. 24 hours after the Worldwide Developer Conference keynote, the stock had repriced 7.5% lower. The forensic methodology had converged on a unanimous four-lens dissent before that repricing happened. All four lenses voted sell: the Auditor, the Architect, the Storyteller, and the Sentinel, three of them with high confidence. The methodology didn't predict the drop. It surfaced a signal that was under the disclosure stack. The market was about to absorb. I'm going to walk you through three questions. Is Apple overvalued? And this lends itself to a what would Warren do question. What signal got missed? And what does AI mean for services growth? The audit trail is what's public. The methodology's DCF intrinsic landed at $157.59. That's anchored to Apple's actual fiscal year 2025 reported revenue growth of about 6%. Wall Street consensus projects forward at 8 to 11% compound annual growth rate. The methodology is deliberately using observed actuals, not forward projections. At $290.55, the stock is 84% above the methodology's intrinsic value. The DCF verdict is a strong sell. The cash rule of 40 still fails at 33.2. That's an operational efficiency signal that doesn't move with price. In defense of Apple, their management has a history of using that wisely, so this number is not a sell signal by itself. First, the easy question: is Apple overvalued? The methodology is unambiguous on the valuation math. The harder question is, what got the methodology to this point? With respect to what signal am I missing, the market already sees this signal. Apple Intelligence appears 0 times in the fiscal year 2025 10K MD&A section, where management characterizes companies' growth drivers, and 0 times in the Q2 fiscal year 2026 10Q management discussion and analysis section. Risk factor AI language doubled over the same window. AI is a risk worth discussing as a risk, but not as a growth driver worth claiming in management discussion and analysis. Services growth attributed in management discussion and analysis to advertising, the App Store, and cloud services. 3 named drivers all under active regulatory attack. Commercial relationships added to risk factor investment disruption language in fiscal year 2025. It reads now as forward-looking preparation for the Gemini deal. The ES&G, environmental, social, and governance language, formally was removed in the fiscal 2025 risk factor. So Q2 FY 2026 risk factors explicitly discloses Google search distribution at risk. DOJ, Department of Justice, remedy reversal could prohibit Google from offering commercial terms for search distribution to Apple. Apple's services revenue depends on this. So let's get back to what the architect surfaces. Apple's own management discussion and analysis section of the fiscal year 2026 10Q, where they discuss their growth drivers, AI is notably missing. AI is mentioned 0 times in their annual report and 0 times in the most recent quarterly. At the same time, management has doubled their AI-related risk language. Now let's look at 3 other companies and how they write about AI in their most recent quarterly filings. Microsoft mentions AI in management's discussion 62 times. Alphabet mentions it 9 times. Apple mentions it 0 times. Apple's AI commentary lives entirely in the risk factor section, the place where you flag concerns. Microsoft and Alphabet put it in the section where you describe how the business runs. That's the disclosure language pattern that the methodology surfaces. The only thing I can take from that is that management views AI as a risk worth disclosing, but not as a growth narrative worth highlighting. That is a disclosure pattern, not a guess. The same disclosure stack flagged something else. In Q2 fiscal year 2026, the quarterly explicitly discloses Apple's services revenue has a major dependency, a $20 billion a year from Google search distribution arrangement. We have another notable pattern. Berkshire reduced their position by 75% over 9 quarters. What drove the massive sell-off? At the 2024 Berkshire Hathaway annual meeting, Buffett explicitly stated that he was selling shares in anticipation of the U.S. corporate capital gains taxes increasing in coming years. So he locked in some profit. He purchased Apple when it was trading at a discount, around 10 to 15 times earnings, and sold it when it was trading around 30 times earnings. When stocks are priced to perfection, it can be a time to take some chips off the table, he says. The methodology doesn't claim to know what Berkshire is thinking. That drifts to speculation about non-public reasoning. But we do factor in what Berkshire has made public, and he obviously thought it wise to move some of his position out of a company that is priced for perfection. The third question is, what does this mean for Apple services growth? The earnings call evidence mirrors the disclosure language exactly. Apple's intelligence mentions each of the earnings calls went from 34 to 31 to 11 to 6 to 5. Management de-emphasized AI in the spoken commentary at the time, when the same filing stopped covering it in MD&A. Here we have two different methods of disclosure with the same signal. Is that what you're missing? This week's Worldwide Developer Conference announcement closes the loop. Apple licensed Google's Gemini model for a heavy reasoning layer over Siri. That's $1 billion a year out. Apple has 2 commercial dependencies on Google now. $20 billion a year coming in from search distribution, $1 billion a year going out for AI licensing. The disclosure stack was preparing readers for this. The market repriced minus 7.5% the 24 hours after the methodology converged. The methodology landed on hold with an asterisk, but the asterisk does not mean what it usually means. Usually, the asterisk preserves a split jury, 2 saying one thing, 2 saying another. This time, all 4 lenses voted sell with high conviction, or with conviction. The auditor voted medium, architect, Storyteller, and Sentinel all had high conviction. The methodology refused to fire sell anyway and held the verdict at a hold. That's the methodology saying all 4 lenses are screaming the same thing, and I'm preserving the dissent signal rather than compressing it into a trade signal. This is the kind of decision that matters most when you're inside the retirement bridge window. The methodology won't tell you whether to take profits. What it shows you is what all 4 lenses converged on dissent before the market repriced 7.5% out of the stock in 24 hours. The methodology is more conservative than Wall Street. It uses observed actuals while consensus projects forward. The gap is the story. The audit trail is what's public. The rest is your call. I do not hold a position in Apple at the time of this video recording.